Yonghapu, CIO at UBS Wealth Management, joins us from Hong Kong to talk about just that. Yongha, hi, morning. Firstly, what is it that you're expecting from the FOMC meet? Is there any scope of announcing any stimulus?
Well, I would say that after the recent non-farm payroll number, which obviously is disappointing and below the consensus, which means also the U.S. labor market is still facing a lot of the difficulties. I think the FOMC or Fed probably will announce the QE3 in the coming FOMC meeting. And I think Bernanke already hinted in the Jackson Hole meeting as well, so that if the labor market do not improve and the downside risk for economy is still very, very high, and Fed will to do whatever is necessary to help economy. So I think the chance for Fed to do the QE3 in the coming FOMC meeting probably is about 80%.
Yonghapu, but do you think irrespective of a QE3 or no QE3, markets could correct? Because by and large, in the run-up to the FOMC meeting, at least in equities and commodities, has been quite strong.
Well, I think in terms of the market reaction, I think after non-farm payroll number, you can see the gold price increase about $30 jumped. So in a sense, the sum of the sort of the part of the markets already priced in this kind of the QE3. I would expect the impact on the financial market will be relatively moderate, considering the previous couple of the QE measures. QE1 helped the U.S. market increased about 20%. QE2 is probably about around 10% of the increase due to QE2 and operation twist, and even less. So I would expect that QE3, the impact on the equity market or overall financial market will be relatively moderate. And on the top, I think the U.S. equity market already on the peak in terms of valuation, and I think index level already reached a quite high level. So in that sense, I wouldn't expect a huge impact on the global financial market. Maybe putting some pressure on the U.S. dollar. That's why we see that recently euro has been recovering, dollar has been weakening a bit.
So Yongha, where do you see the markets headed post these macro events for the remainder of the year?
Well, I hope I have a crystal ball to tell you, but my feeling that in the coming months, the market will remain very volatile. We're going to have a German constitutional court to approve the ESM. We're going to have the Troika to make assessment whether or not Greece had enough of the progress on the austerity program. So a lot of the annual events, which may be going to be still a lot of the uncertainties. And then on the top of that, even the ECB announced the OMP, the program, bond purchasing program. It doesn't mean that they can do whatever ECB wanted it to do. There is a lot of the conditionality attached on that, and those conditionality will also see whether or not Spain or Italy want to put up an application for bailout funds and so on. So still a lot of uncertainty. In the China side, we also see that the official has put up some of the stimulus, but the size of the stimulus plus some policy are still not very clear, and they certainly don't want to make a mistake they made in 2008. So in that sense, I think before the year end, we will continue to see more volatility, basically because the economy-wise, I think still decelerating from U.S., from China, from Europe is probably close to the recession, and the only policy seems supportive. In that kind of environment, I would see a much more volatile financial market before the year end.
Now, there's a widespread expectation that the stimulus in US economy or the QE3 will fuel a strong rally in emerging markets like India. So assuming that if cheap liquidity is here to stay, do you expect Indian markets to rally further in the next 3 months?
Well, Indian market has been under some pressure due to the rising current account deficit, and there are also rumors say they're going to downgrade Indian sovereign rating. Of course, the official has come out to say that make a promise to do things to avoid being downgraded. I think, of course, this kind of situation is not going to be positive for India. On the top of that, we also see capex spending by corporate are also coming down. If India cannot sort of embark a good investment into infrastructure, into capex, I think India's inflation supply side constraint going to remain, which obviously doesn't give much room for RBI to cut the interest rate. So in that sense, India is still struggling with the headwind from the global, from domestic. I think so far Indian market has been performed relatively okay. The reason is because, of course, after QE in Europe, particularly the ECB's announcement that will release some of the pressure on the Indians' funding issue, but I still expect some of the pressure remain in the Indian. So I think in the short term, India is also facing kind of slowdown. So in a sense, we are relatively neutral on the India.
Priyanka, what's the one trigger that one should watch out for, which will give markets direction next?
Well, I think at least one front is clear, the policy front, that from ECB, from Europe, from US, from China, the policymakers try to be more supportive, come up with more either QE or fiscal stimulus. But then the real economy is really not recovering. They are under lots of pressure from either from the US or from Europe. So in that sense, I think I would expect more the turning or recovering of the real economic activities like inventory rebuilding, or at the moment there is a lot of destocking taking place, which is not good for real economy. So I would see like a leading indicator of the manufacturing sector around the world start to pick up. And then if we see the inventory destocking process near the end, then obviously this is going to be a positive for the financial market. At the moment, only one leg is positive, which is a policy, but another leg on the real economy side, we haven't seen any sort of the real economy start to picking up or to rebound yet, at least from the major economy around the world.
Final question. Indian markets have appreciated by about 15% already this year in local currency terms and about 4-5% in dollar terms. So where do you see value in this market?
Well, India's market, yes, has rebounded, partly due to the rupee's stabilization and partly due to the ECB's bond purchasing program, which obviously reduced the tail risk of the euro breakup. On that sense, I think that's why the Indian market has recovered some bit. But still, if you look at the domestic front, the industrial productions or inflations or fixed asset investment, I think India are still facing a lot of headwinds. So in that sense, probably we still like more consumer sectors, which is going to be relatively beneficiary over the longer term. And some of the banking sector, because we're well involved into the consumer loans and so on. Apart from that, we still need to see more policy initiative before we are more bullish on the India.